Hello and welcome to a brand new episode of ET Markets PMS Talk, a show where we discuss the opportunities as well as investment strategies deployed by the fund manager in the popular space of ultra HNI investing. My name is Shatajanand and today we have with us a very special guest, Aniruddha Sarkar, who is a senior portfolio manager and co-head of equities at Quest Investment Advisors. Welcome to the show, Aniruddha.
Yeah, hi Kshitij. Good morning.
Morning. And thank you for being part of the segment, Aniruddha. Now, the flagship multi-cap PMS scheme has been there for more than 15 years. If someone had, remained invested for, let's say 50 lakh, would have turned into considering a CAGR of 15% because there are very few schemes, especially in the PMS, who are decade long.
Yeah, I think the Quest flagship PMS is something which we are very happy because out of all the so many hundreds and thousands of PMS schemes as of today, it is one of those few schemes which has a 15-year plus kind of a track record, and it has seen all the good times, bad times. You name the events from 2007. So we would have launched the fund just before the global financial crisis, and it has seen everything: financial crisis, the European crisis, IL&FS, pandemic. In spite of all that, it has given roughly around 15.7% annualized return, which means a 50 lakh rupees invested 15 years back would have become roughly around 4.9 crore, or you can say 10 times in 15 years.
Wow, that's amazing. And that's the power of compounding if somebody has to understand that in a nutshell. In fact, a very good number and very few schemes which we have also seen who have stayed that long and given that kind of consistent returns. That is something which is, all kudos to you and the company itself for their risk management practices as well as the way they pick stock. So we'll come to that definitely. Now let me go on to the other one. The more recent multi-PMS scheme has also delivered impressive returns. Tell us more about the investment strategy of that particular scheme.
So the Quest multi-PMS, we launched it in August 2014. So I would say that also has a decent track record of around 8-9 years now. And that also kind of, is very much similar with regard to the flagship returns. Like flagship has a much longer period, but the Quest Multi also has around 14.5 to 15% annualized return over the last 9 years. The strategy which we follow in the Quest Multi is basically the two-pronged. One is sector rotation, and second is the market cap rotation. Now I'll come to the sector rotation a bit later, but the whole idea about the market cap rotation is basically, as the name itself says, a Quest multi-portfolio, is to be agnostic between the large cap, mid cap and small cap, depending on the market conditions. Over the different time frames, if you see, there are times when the large caps look good, there are times when the mid caps look good, and there are times when the small caps look good, both on the valuation front, earnings upside, the risk reward framework. Investors typically, they tend to jump between the large cap fund, mid cap fund and a small cap fund. But in a Quest multi PMS, he gets all of that in one fund because we as investment managers are taking that call whether we need to be more overweight on the large caps or the mid caps or the small caps. If I see the history over different time frames, we would have gone up to almost like 70-75% into the large cap at times. And there are times when we would have gone up to like 60-70% into the mid and small cap. So depending on the market conditions. Now, coming to the second most important strategy which we follow in the Quest Multi is the sector rotation concept. Now, it's very simple, as the name itself, implies. To put it in a simple words, I would say be there in the right sector at the right time. Easy to say, difficult to implement, but I would say that it comes with experience and time that you need to be there in the right sector where the earnings up cycles are. And the whole idea about the sector rotation is that, you identify the up cycles in different sectors, look for sectors where the earnings upside is going to happen. You can say many a times it is one of those hated sectors where, very few people want to talk about it. And you try to get a bit early on over there and you try to build position in good companies in that sector. So idea of sector rotation is to ride the economic cycle, earnings cycle and the valuation cycle, which kind of is there in different companies. Now, if I see in the last 7 to 8 quarters in the Quest multi PMS, there has been a visible trend of decreasing allocation towards export side and increasing allocation towards the domestic side.
True. Yes.
This is a macro trend. Now that would get reflected into wherein we went underweight. I'll just give an example. We went underweight big time into the IT sector, and practically we don't have any IT. So we would be one of the only funds, I think, which we don't have any IT. But we increased our allocation towards everything to do with the domestic, whether it is domestic consumption, industrials, etc. So sector rotation is the core philosophy around which the Quest multi PMS operates.
Right. Now, definitely sector rotation is one bit, but within the sectors, how do you pick stocks for your PMS scheme? So what are the different filters, that you put across for picking stocks?
See, I would say that, when I say sector rotation is what we follow, many times, investors, they think that, we are looking more of a macro and we are the macro investors. Right. I try to put it across that, macro outlook can take you to some extent, but at the end of the day, we have to buy the companies. I cannot buy the macros. So I would say that, end of the day, we are still the bottom-up pickers. We look at the bottom-up ideas, but I would say the process begins from the top. We identify the sectors we want to be in, and then we are looking at, which are the companies within that sector which we want to kind of, enter into. I would say that, one thing I keep saying again and again is that there is no information arbitrage as of today. Everyone has the same set of information, whether it's financial or numbers or anything. Only thing which is there at our disposal, I would say, is the interpretation arbitrage, which means, what sense do you make of the different macro and the micro data? I would say we lay a lot of emphasis when you talk about the filters for evaluating companies. I would say we lay a lot of emphasis on the softer aspects to it, because that is something which I would say differentiates one investment manager from the other. Because end of the day, if you feed the same numbers in an algo and have the same parameters, algo will give you the same output. But we are not algos. I would say that, that is where, the differentiation happens. And that is where I would say we try to put that into perspective. So I would say the first and most foremost filter for us is the management quality, management's track record of executions, management's ability to execute what they promise, and also the management's ability to be ahead of the curve with regard to innovation, with regard to being ahead of the competition. And that is what we spend a lot of time in understanding. How is the management, the software aspects of the business? Once the company meets the parameters with regard to all the management filter checks, then we look for companies where the ROE profile is improving. We look for companies where the margin profiles are improving. We look for companies where the market share is improving. We look for companies where the company has increased pricing power in the space which it operates. Also, we do look for companies wherein the balance sheet is quite, I would say, the leverage is not high. Now, I would say that, when I say leverage, the common thing comes that, that why should you look at companies with leverage? That is where, again, I would say we are a bit different, because we do look at companies which have leverage, because typically the cyclical companies are the ones which are sitting with the high leverage. Right. And if you're able to catch a cyclical company at the bottom of the cycle with a high leverage, as the earning cycle goes up, the leverages come off, multiples improve, and that is where the whole multiple expansion happens. So we are not, I would say, averse to companies, who have some leverage on the books. But yes, it should be a leverage which you can service. It should not be something which can take you out of business.
Absolutely. And in fact, I was going through the fact sheet, and in your flagship scheme, the portfolio is heavily invested in the financial services as well as consumer services. So, and a part of it, you already explained that the portfolio is slightly being drifted into the domestic economy part. So, what makes you confident in these two sectors?
If I look at the portfolio, I would say that we can broadly break it up into these three major buckets. Now, I call them major buckets because it is like the way I would break the compartments for the portfolio. The three major allocations in the portfolio will be, one will be financials, right. Second is consumption, and the third I would say is industrials. Okay. So these three form, I would say, the pillars of my portfolio as of now. If I'm bullish on India, I have to be bullish on financials, consumption, and industrials. Now, if I look at the reasoning why I'm confident on these things, and if I look at the financial part first, the lending growth is, I would say, accelerating at its highest pace, which we have seen in the last so many years, and almost like an 8 to 10 year high. And after coming out of the COVID, after coming out of so many of the crises, I think that's a very encouraging data. And that is where I would say the balance sheet of most of these banks, who have come out of that NPA cycle, they have improved a lot and they're well capitalized. In fact, now it is a case wherein the managements are pushing the banks to kind of lend because your balance sheet is so strong and you're not lending. So I would say the lending growth is something which is very encouraging. Second is, I would say, if I'm bullish on the domestic capex cycle, if I'm bullish on the domestic PLI cycle, more and more manufacturing things happening on the domestic side. Also, the fact that capacity utilization is also picking up, and historically we know whenever the capacity utilization goes above 70-75%, that is the time when the fresh capex cycle comes in. I would say, all these things are giving me the confidence that the financial cycle is here to play out. And if I look at the type of the lending growth which is happening, it is happening across the retail and the corporate side. It is not just one part of it. It's a broad-based kind of a lending growth which is happening. So that is my optimism on the financials. Coming to the consumption part of the portfolio, why I'm bullish on consumption. There are two broad trends I would highlight with regard to the consumption. One is the premiumization of the consumption, which means you are wanting to migrate to the high valued products. And second is the formalization of the consumption, which is basically the shift from unorganized to organized. So these are two broad trends which we are trying to play. One is shift from unorganized to organized, and second is the ticket size of the consumption items which you're buying, that going up. And if I broadly put how our consumption allocation is there in the portfolio, we are very bullish on the whole urban consumption. And if you look at the portfolio also, we don't have any allocation to anything to do with the rural consumption. It is all about urban consumption, whether it is hotels, whether it is the retail, whether it is the travel and tourism, whether it is autos, and within autos, the passenger vehicles and the commercial vehicles. So it's more about urban consumption, and that is where we are very bullish on. And lastly, the third pillar of my portfolio will be the industrials. And that goes without saying, if you're bullish on India for the next 5 years, looking at a 5 trillion economy, manufacturing, which makes up around 14% of our economy, is bound to go up to almost like 20% in the next 36 to 48 months. And when that happens, you'll have all the industrial engines, at the full steam. And capex cycle, whether you're talking about capital goods, you're talking about the welding companies, you're talking about cement, ancillaries to the engineering goods, all of that is what we are bullish on. And defense also forms a large part of our industrial focus. So these three, I would say, are the major pillars of our portfolio as of today.
Oh, absolutely. In fact, if you look at the collections or the GST collections that we have seen so far, 1.5 lakh crore, I mean, that's tremendous. And we've been clocking that consistently or above the 1 lakh crore mark. So yes, the economy is slowly moving toward the formalization or the formal economy, and that's very good from all aspects. Now, we are indeed, heading towards record high, just 1% or 2% away from that particular number. How should investors play the small and the mid cap theme?
In fact, for the last 4 to 6 months, we have been of the view, and in fact, we have been saying this in all our investor communications, that the next 24 to 36 months, you will find the small and mid cap outperforming the large caps. Okay. And there are multiple reasons to it. Could be valuations, could be the balance sheets, etc., etc. But I would say that our view is that investors should focus on the small and mid caps for the next 24 to 36 months. Okay. But I would say that you should not be looking at a very, very broad-based allocation. You have to be very focused what you're buying. And I would say that remains the same for even any company, any sector you're looking at. So I would say our way of looking at the small caps and mid caps would not be very different compared to what we are looking for in other spaces of the market. But if I have to just highlight some pointers, what investors should look out for in the small and mid cap, I would say you should look for sectors, which have the tailwinds and the growth drivers as we stand today, because that is where the big multiplier effect happens in the small and mid cap companies, wherein the sector is going through a massive tailwind and it takes the small companies to a much, much bigger space where it is going to operate. Second thing, very important, is to look at the balance sheets of the companies in the small and mid cap space so that they are not over leveraged. Because typically what happens is when the interest rate cycles are pretty high now, if you have a large leverage on your book, it takes away a good part of your earnings. That should not happen, because if the earning cycle goes down and you are sitting with a high leverage, even then definitely it will hurt you. So I would say we look for small and mid cap companies where the balance sheets are not leveraged much and it's very, very comfortable. In fact, if I look at my own portfolio of the small and mid cap companies, they would hardly have any leverage on their balance sheet. The third thing should be focused on, if you're looking at these companies, is that where the capex is already done and capex is about to come on stream. That is a very, very big inflection point when the small and mid cap earnings take a massive upturn, and that is where the market starts giving it a higher multiple. So look for companies in the capex completion stage and which is going to come on stream in the next couple of months. Quality of promoters goes without saying. There can't be any compromise on that.
True.
And all the more if you're looking at small and mid-cap companies, that is where more of the accidents happen. So I would say you have to be extra careful. And in fact, when I look at companies in that space, we spend a lot of time in visiting the company's management, plants, talking to their factory workers to get a sense how the management quality is. So I would say quality of management in the small and mid caps becomes all the more important. And lastly, I would say look for companies in the small and mid cap space who are increasing their market share in their area of operation and who are launching new products or who are entering the new markets, wherein all these things along with the capex completion is the right ingredient to take you to a much higher earnings platform.
No, absolutely. You've summarized most of these pointers very beautifully. I'm sure our viewers will take note of that. And any new stocks which you've just added to your schemes and exited recently?
So I would say the names which we would have added in our portfolio, is to do with the themes which we would be kind of bullish on. And I would say the domestic consumption theme is something which has been the most recent addition. And when I say most recent, could be 6 months from where we are today. So the names which we would have added is a couple of names in the retail space. We added something like the Trend. So the disclaimer is we would be having all these names in our portfolios of our clients.
Right.
So Trend would be one of the names. Zomato would be one of the names. I remember when we bought Zomato at around 50 rupees plus minus, investors were very afraid that you're buying into the new age companies and these companies are falling every day. Idea was that we bought it almost like a 40% discount to the IPO price.
IPO price, true.
Now what comfort do you get? And that was kind of you can say practically the rock bottom.
Right.
So we got into Zomato also at a good price. The other name which we would have added is Indian Hotels and EIH. Both of them being a part of the travel and tourism. We are seeing the type of the hotel demand and the pricing comfort which they have. So it's not good for me as customer, but yes, for me as an investor, it's a very good thing. Right. That the hotel business is kind of doing extremely well. And we would have bought into auto ancillary in a big way. Within auto ancillary, we would have bought into Mahindra CI. Right. So these would be kind of the names which would have entered most recently in the last 6 months. What we would have exited, as I mentioned earlier, we have been underweight on IT for a long time. And it has definitely helped us being underweight on IT. Underweight to the tune that, index has around 13-14% IT, and we had almost like 6-7%, half of what the index had. Last couple of weeks, we would have practically exited the IT also, whatever we had. So we are now at completely zero allocation to IT. It's a big risk, I know. If you have 14% in the index and you don't have anything, what if that sector starts doing well? But my view is that I would remain negative on IT at least for the next 6 months, if not more. So IT complete exit is something which we have done. We have booked some profits from the defense stocks, which we were very overweight on earlier. We had a high allocation towards defense companies, which has done very well for us. We have booked profits out of defense because I think the market is factoring in way ahead. Already, people are talking about FY 26, 27, 28 numbers and, discounting it backwards. So I would say valuations are something which is not very comforting. But yes, if you ask me, sector is definitely here to stay, but we have taken some profits off over there. So these would be the broad entries and exits which we would have done in the portfolio.
Right. In fact, for differences, the PE expansion happened a little too early. I would say that, but earnings are yet to catch up. Next thing is also related, or next question is also related to, so how do you manage risk and what are the tools that you use in managing the risk, which is an important part of managing the portfolio?
Interestingly, I'll just give you a different context. When I talk about the risk management, when I talk to, domestic investors on the HNI side, the risk management is the last question they ask. Okay. In fact, they don't ask. To be honest, they don't even ask about it. Yeah. When I talk to foreign institutional investors, the risk management is the first question they ask. Okay. And that is the focus area. But I always highlight to investors that the risk-adjusted return is what one should look at. I should not be taking, undue risk just to generate return, because at the end of the day, when the market takes a turn, a high-risk portfolio is definitely going to get hit. And we have seen that. You would have seen, I would have seen that, in the bad times, the risky portfolios get hammered. So I would say the risk management is very important in our portfolio, and how I do it. One is ensuring that we have the weight management system in our portfolio, wherein for any small cap, we have defined a particular weightage that, any small cap company should not go beyond this particular weightage. Any mid cap company should not go beyond this much weightage, and a large cap company can go up to say 10% of the portfolio. Also, for a small cap company, we should not own beyond X percentage of the company. Otherwise, it should not happen that I'm sitting with a big chunk of the company and something goes wrong. I have no other option to exit, but you have to sell at a huge discount. Right. So the weight management of the small, mid, and large in the portfolio is something which is very, very important, and that is something which you pay an eye on. Second is I would say the impact cost of entry and exit. That it should not be a very, very illiquid company, because if you're sitting with a very, very illiquid company, buying is easy. I would say the easier job is to buy a stock. Difficult job is to exit a stock, because either you would exit when things turn bad, and when things turn bad, you will not find any buyer on the market. So the liquidity management or the impact cost management is something which we keep a tab on, that how many days it would take to enter the position and how many days it would take to exit the position. Right. So that helps us to ensure that there's not a very, very illiquid portfolio which you're sitting with, which will hurt the investors' return when the things turn bad. So these are the broad, I would say, the risk management things which we do from a portfolio perspective. From a more, I would say, entry point perspective, I would say the aspect which I mentioned about the management quality, that is something which we spend a lot of time on. And thanks to that, I would say there has been no such cases of our portfolio companies wherein a corporate governance issue would have emerged. So that is a very big risk management which people don't factor in, because it's a more, I would say, the softer aspect to it, but it's actually a parameter which can't be quantified. But if you are able to take care of that aspect at the point of your entry, I think many of the big accidents can be avoided. And we have ample examples of, such companies, which were the hot favorite of the street, and there has been a corporate governance issue and the stock has been hammered. That's a very big risk management, so that at the point of entry, you do your check that there are no quality aspects with regard to the business. So these would be, I would say, some of the broad the risk management parameters which we are looking at, while building up the portfolio.
Right. On that note, thank you so much for your time, Aniruddha. And that's all for now. But to stay, log on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.
Thank you.